Wednesday, June 23rd, 2021, Maneco 64, home of alternative economics and contrarian views. Today we're going to look at how the Fed's own measure of inflation is pointing to 15% year-on-year growth of inflation. And by inflation, of course, I mean the classic definition of inflation, as inflation is purely a monetary phenomenon resulting in higher prices, right? So that's the Merriam-Webster dictionary from the 70s. And what does it say about inflation? Well, it says an abnormal increase in the volume of money and credit, resulting in a substantial and continuing rise in the general price level. So CPI or PCE, those are not inflation. They are the general price level, a measure of price levels. And of course, the government over the years has tinkered with that data. They've done things such as substitution, hedonics, to make it look like there is no price rises, or what they call now inflation. That's the other thing they've done. They've changed the definition of inflation to mean the consequence of inflation, which they can doctor, but they can't doctor the growth in money supply, M1 or M2 even, which is a much broader measure. And yes, the Federal Reserve has altered the M2 data. And is it to hide it? Maybe partly, but I think it's to smooth it out, to make it not look as bad as it is in terms of growth. So as you can see here, this is how it used to come out, this discontinued M2. And it used to be every week, right? But now it's every month, and look how much smoother it is. It looks like it's not growing at all, but if you go through the numbers, which I have and other people are doing as well, you will see that it's actually growing at a very alarming pace. And that's why I don't think what they call inflation is temporary at all. Yes, there was a big blip last year around the when the crisis started. So it's going to show up, of course, in the numbers this year. But now we're gone past the time where there was the blip last year. And even if you look at the last few months, as I have looked, the annual rates are going up at double digits. You'd expect the annual rates to be going up at double digits when you measure from last year, like around March to March this year. But now it's continuing, like April to May and March to April. So before I look into the data, just wanted to go through the definition of M2. Some of you might not know what M2 is, M2 money supply. So in Investopedia, we'll go through that. So it says here, M2 is a calculation of the money supply that includes all elements of M1 as well as near money. M1 includes cash and checking deposits. It also includes traveler's checks, which is something we don't use anymore, of course, while near money refers to savings deposits, money market securities, mutual funds, and other time deposits. These assets are less liquid than M1 and not as suitable as exchange mediums, but they can be quickly converted into cash or checking deposits. This is their key takeaways. M2 is a measure of the money supply that includes cash, checking deposits, and easily convertible near money. M2 is a broader measure of the money supply than M1, which just includes cash and checking deposits. M2 is closely watched as an indicator of money supply and future inflation. I think Investopedia means future rise in prices. And as a target of central bank monetary policy, well, not anymore, I would say. Maybe for private consumption, the FOMC looks at it, but for the public, they try to keep M2 in the background. I think someone asked Powell maybe last year or a few months ago about M2 during a congressional testimony. And he says, oh, M2 doesn't matter to inflation. And before I go through the numbers, just wanted to show you, of course, some of you probably know about John Williams' shadowstats.com. And he's got an alternate measure of inflation. He takes inflation the way the government used to calculate it, or there you go, I fell into the trap. I said inflation. He takes the CPI, how the government used to calculate it, for example, in 1980, before they started tinkering with the numbers. It's that old saying, isn't it? Benjamin Disraeli said something about statistics. Lies, damn lies, statistics, something like that. You can always play around with statistics. But as you see here, according to the way the government measured CPI back in 1980, it would be around 12.5%. So this gives you an idea why that's not surprising when we look at M2. The other thing is, I would say as well, even the measure of broad prices like CPI, we always hear about this base effect, right? But base effect in terms of in relationship to the pandemic last year and the lockdowns should work on a year-on-year basis. A big drop in March and April this year, as it rebounds, is a big increase off a very low level. But now, as Wolf Richter here of the Wolf Street Report said back on June 10th, he looked at this question. He says, it gets ugly. Dollars purchasing power plunged at fastest pace since 1982. It's permanent, not temporary, won't bounce back. That's the dollar, of course. But he notes here about the CPI. He says the consumer price index jumped 0.6% in May after having jumped 0.8% in April and 0.6% in March. All three the steepest month-to-month jumps since 2009, according to the Bureau of Labor Statistics today. For the 3 months combined, CPI jumped 2%, or an annualized pace of 8.1%. So this 8.1% is not, it's annualized, but it's not from last year. It's the last 3 months this year that have had CPI recorded. So he says here, this current 3-month pace of inflation as measured by CPI has nothing to do with the now infamous base effect, which I discussed in early April. So there you go. So you probably want to know what M2 is doing now in the US. And this data, of course, is published by the Federal Reserve Bank of St. Louis, or Fed. I'm going to put the link to the new version of M2 below in the description. And you can go there and check that my numbers are right, that I'm not making this up. So the latest number they have is for May. So let's go on to it. So right now, the May M2 money supply is 20,370,000,000.1. And in April, it was 20,118,000,000,000.8. So that was an increase of 251.3 billion. So it's an increase of 1.25% month on month. Annualized, that works out to 15%. So looking at that shadow stats number there, around 12.5%, it makes sense, right? Yes, of course, there is the Cantillon effect, which is probably flowing into the places they don't like, the powers that be, consumer prices, service prices. People are going to start to notice, yes, they have been tinkering for years with these numbers, but they were able to get away with it. But now I think the proverbial frog in the pot is starting to feel that he might boil to death. So anyway, I looked as well at the March to April number, and that's gone up. Well, that went up, 12.4% on an annual basis. So there is no base effect here to look at. We're looking at month-on-month numbers this year, and they translate to double-digit increases so far this year. And if you look at May 2020 to May 2021, which we could say there is a base effect there from last year during the crisis, the increase is 13.84%. So right now, M2 is growing at an even faster rate than during that period. Yes, of course, there's a lot of people out there who still think this is temporary, this is contained, just like Ben Bernanke said before the you know what hit the fan in 08-09, that the subprime market crisis was contained. People are saying that this is all temporary, that it's transitory, but I don't think so. I think people really need to be careful in terms of the purchasing power of their savings. And as I've said many times, the best way to protect that when you have a raging inflation like we're having right now is to be in tangible goods like commodities, precious metals, gold and silver. Yes, there are stocks out there, commodity stocks for companies that mine commodities that would do well. As I've said many times, I'm not here to advise people on what stocks to buy and what to do. But I'm just trying to give you my opinion, my idea of what's really happening. This kind of stuff you probably won't hear on CNBC or Fox Business Channel or whatever other mainstream channel. And you might disagree with me. You might think that inflation is transitory and we're going to go back to 2% or 3%. But even at 2 or 3%, that's a huge haircut on the purchasing power of your money, I would say. And how come bond yields are so low? Well, because the Federal Reserve is using a policy that was used basically after World War II, called financial repression. They keep nominal yields suppressed and real yields deeply negative in order to write off the debt, because we're approaching 29 trillion. It's not going to get any better, the national debt and other debts as well. So there you go. With that, let's quickly look at where the markets are this morning. It's just before 8 a.m. London time. We've got spot gold, $1782.50, up $4. Range has been $1777 to $1784. Silver is up 15 cents, just under 2/3% at $25.92. High's been $26.02, low $25.74. The Dow future is up 112, 1/3%. NASDAQ 100 future up 38, 1/4%. S&P future, 500 future, up 10 or 1/4% as well. The currencies, sterling is up slightly, 139.59. Euro is down slightly, 119.32. The dollar is up 0.2% versus the yen at 110.85. Dollar versus the yuan, strengthening quite a bit here. We're almost up to 650. We were below 640 up until a couple weeks ago. So we're at 648.92. Aussie dollar is strengthening back up to 75.50. We got down to below 75, I think, earlier this week. And just to look at the commodities here, general commodities, high-grade copper up just under 4 cents or under 1% at 425. WTI crude is up 2/3% at 73.23. And the 10-year yield up about 1.5 basis points just under 1.49%. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.